Picture a Tuesday morning before the doors even open. The lights are off in half the corridors, the fountains are silent, and a lone security guard is walking past storefronts that are still dark. Within 3 hours, the same building will hold thousands of people, dozens of cash registers will be ringing, and every single one of those transactions will quietly be making money for someone who has not sold a single item all day. That person is the landlord. Most people walk through a mall and think about what they are buying. Almost nobody thinks about who owns the floor they are standing on and how that person turns a building full of other people's businesses into one of the most reliable income machines in modern real estate. This is the story of how that actually works. And it starts with a man named Daniel who, 3 years ago, bought a fading regional mall outside Charlotte, North Carolina, for a fraction of what it once sold for, and turned it into a case study in how commercial real estate really makes its money. When Daniel signed the papers, the mall was 1.1 million square feet, built in the late 1980s, anchored by a department store chain that was already on its way out and running at just under 70% occupancy. The seller was desperate. Analysts had already started calling properties like this one a value trap, a place where the price looks cheap but the cash flow keeps shrinking. Daniel didn't buy it because he loved retail. He bought it because he understood something most shoppers never think about, which is that a mall owner is not in the business of selling clothes or electronics or fast food. A mall owner is in the business of renting space, and everything else, every entertainment zone, every food court, every parking lot, is simply a tool to make that space worth more. The foundation of the entire model is the lease, and leases in shopping malls come in a few very specific flavors that most tenants understand deeply, and most customers never think about at all. The most basic structure is a straightforward base rent, a fixed dollar amount per square foot charged every year, similar to any apartment or office lease. But most mall leases go further, layering on what is called percentage rent, where the tenant agrees to pay the landlord a small cut of their gross sales on top of the base rent once those sales cross an agreed threshold. This single mechanism is the reason mall owners care so much about foot traffic and tenant success. If a clothing boutique in Daniel's mall does well, Daniel does well without lifting a finger or selling a single shirt. The smaller specialty stores and inline retailers, the ones squeezed between the big department stores, typically pay the highest rent per square foot because they occupy prime, high-visibility real estate along the main walkways. In many markets, those inline spaces in a strong mall command somewhere between $35 and $80 per square foot per year, sometimes more in the busiest wings, while a big anchor department store might pay only $8 to $15 per square foot. That gap looks unfair until you understand why it exists. Anchor tenants like department stores, supermarkets, or big electronics chains typically occupy somewhere between 45 and 70% of a mall's total square footage, and their entire value to the landlord isn't the rent they pay directly, it's the crowd they pull through the doors. Industry data on grocery-anchored centers shows the same pattern playing out in numbers that are almost shocking when you see them side by side. In one well-documented case, a grocery anchor, occupying roughly half of a shopping center's space, was paying only about $11 per square foot, contributing less than 30% of the property's total rent roll, while the 14 smaller inline tenants around it were paying nearly 3 times as much per square foot, because that grocery store was pulling in over 20,000 customer visits every single week. Daniel's Mall worked exactly the same way. His anchor department store paid a heavily discounted rate, but its presence justified premium pricing throughout the rest of the property. On top of base rent and percentage rent, every tenant in Daniel's Mall also pays what is called a common area maintenance charge, usually shortened to CAM. This is money that funds the cleaning crews, the security patrols, the escalators, the lighting in the hallways, the landscaping outside, and the general upkeep of everything that isn't inside an individual store. CAM charges are typically billed as an additional per square foot fee on top of rent. And at a well-run mall, they can add another $12 to $18 per square foot to what a tenant pays annually. This is important because it means the landlord isn't fully absorbing the cost of running the property out of pocket. A meaningful chunk of daily operating expense is passed directly onto the tenants who benefit from a clean, safe, well-lit environment. But rent, percentage rent, and CAM reimbursements are only the beginning of how a mall actually generates income, and this is where Daniel's Mall started to separate itself from a simple rent collection operation and start behaving like a diversified business. Parking is one of the most underrated revenue lines in mall ownership. In dense urban markets where space is scarce, paid parking alone can generate meaningful annual income, and even in suburban malls with free parking, structured or covered parking areas are sometimes leased separately to operators who manage and monetize them. Advertising is another quiet earner. Every digital screen near an entrance, every static billboard along a highway-facing wall, every banner hanging above the food court is a piece of inventory that brands pay to use, because a mall with tens of thousands of weekly visitors is one of the most efficient physical advertising environments left in retail. In recent years, this has evolved even further into what the industry now calls retail media networks, where mall operators use foot traffic and shopper data to sell hyper-targeted advertising placements the same way an online marketplace sells ad slots, except the audience is walking past in person instead of scrolling a feed. Then, there are the smaller, almost invisible income streams that add up over a full year. Kiosk rentals in the walkways, vending machine placement fees, ATM leasing agreements, pop-up shop rentals for holiday seasons, seasonal exhibitions, sponsorship deals for events, and even rooftop leases to telecommunications companies who want to mount cellular equipment on top of a large, centrally located building. None of these individually make or break a mall's finances, but stacked together across a property the size of Daniel's, they routinely add millions of dollars a year in income that has nothing to do with a single dollar of merchandise sold. To understand the scale that this model can reach at the very top of the industry, look at the numbers reported by Simon Property Group, the largest mall operator in the United States. In its most recent full fiscal year, the company reported total consolidated revenue north of $7 billion, with the overwhelming majority of that coming from lease income, meaning base rent and percentage rent combined, and the rest coming from management fees and the kind of ancillary income streams just described. Occupancy and average base rent per square foot are treated internally as the two most important operating metrics in the entire business, because even small movements in either number ripple through into billions of dollars of enterprise value. At the very top of the market, somewhere like the Mall of America in Minnesota, the scale is almost hard to comprehend. That single property spans 5.6 million square feet, houses more than 500 stores, draws over 30 million visitors a year, and generates over $1 billion in tenant sales annually, with base rents in its prime sections running between $45 and $55 per square foot, plus roughly another $15 per square foot in CAM charges on top of that. But none of this income comes free. Owning a mall means absorbing an enormous, relentless list of operating expenses that never stop, regardless of how good or bad business is that quarter. Daniel quickly learned this the hard way in his first year. Security has to run around the clock every single day of the year. Cleaning crews work overnight, so the property looks spotless before the first shopper walks in. Heating and cooling a building over 1 million square feet is an enormous, continuous electricity cost, especially in a climate with hot summers. Elevators and escalators require constant maintenance contracts. Property taxes on a large commercial asset are a significant annual expense on their own. Insurance premiums for a property this size, especially one with heavy foot traffic and liability exposure, are substantial. Landscaping, roof repairs, plumbing emergencies, parking lot resurfacing, none of it is optional. And a single major failure, like a roof leak above a busy wing, can cost hundreds of thousands of dollars to fix properly. Daniel's early spreadsheets showed something that surprises a lot of first-time commercial real estate investors. Even in a strong year, property operating costs, real estate taxes, depreciation, and repairs and maintenance combined can eat up a significant share of gross revenue before a single dollar of profit is calculated, which is exactly why net operating income, not gross rent collected, is the number every serious investor actually cares about. Then came the real test. About 14 months into owning the property, Daniel's Mall lost its department store anchor. The chain had been shrinking nationally for years, closing underperforming locations as part of a broader, multi-year restructuring plan, and Daniel's location made the list. This kind of event is far more common across the industry than most shoppers realize. Nationally, malls entered this year with vacancy rates sitting close to 9%, roughly double the vacancy rate of retail space in general, and net mall store absorption, meaning the difference between space that got leased and space that got vacated, was actually negative in the first quarter, meaning more square footage emptied out than was filled. Over the past decade, tens of thousands of individual mall stores have closed on net, even as tens of thousands of others opened. And the property class as a whole has been shrinking, from well over 2,000 large enclosed malls in the United States decades ago down to somewhere close to 1,000 today, with some projections suggesting the number could fall toward 900 within just a few more years. When an anchor tenant leaves, the effects ripple outward immediately. Co-tenancy clauses, which are provisions written into many inline tenant leases, allow smaller stores to demand reduced rent, or in some cases, terminate their lease entirely, if occupancy in the mall falls below a certain threshold or if a specific anchor closes. Daniel watched 3 smaller tenants invoke exactly this kind of clause within weeks of the anchor's closure announcement. Foot traffic near that wing of the mall dropped noticeably. This is the exact mechanism behind what the industry calls a dead mall, a property that has lost its anchors and, without the crowd they used to generate, slides into a spiral of declining sales, declining rent collection, and rising vacancy that becomes very difficult to reverse. Malls that fully die and go dark sit empty for an average of almost 4 years before anyone finds a new use for them, And the average vacant mall that eventually sells goes for something like 43% below what it originally cost to acquire. Daniel was staring directly at that fork in the road. He had two options. He could let the property slide the way hundreds of American malls already had, or he could treat the anchor's exit as an opportunity to rebuild the entire tenant mix around a different vision of what a mall actually needs to be in this decade. He chose to rebuild. The first move was splitting the vacated anchor box into 3 smaller, more flexible spaces, rather than searching for a single replacement department store, because national data on mall redevelopment shows that when big anchor boxes go empty today, only a modest share are ever backfilled by a traditional department store again. Instead, nearly half of all mall redevelopment projects nationally are now mixed use, blending retail with other uses entirely, and residential development in particular has become one of the fastest growing replacements for dead anchor space, showing up in roughly a third of anchor conversions, and in more than half of all mixed-use mall redevelopments overall. Daniel leased one of the 3 new spaces to a regional healthcare system that wanted to open an outpatient clinic, a trend that has become surprisingly common across the country, with dozens of enclosed malls nationally already converted, in part or in full, into medical facilities, because health systems have realized that a vacant anchor box comes with something incredibly valuable already built in: large open floor plates, ample parking, and a location already embedded in a community that people know how to find. He leased the second space to a regional gym and fitness chain because operators increasingly understand that a gym anchor, unlike a traditional department store, brings people back to the same property multiple times a week rather than a few times a year. And those repeat visitors tend to stop for food, coffee, or a quick errand on their way in or out. The third space became a mixed food and entertainment hall featuring a rotating lineup of local restaurant concepts alongside a small events venue that could be rented for private parties, community meetings, and seasonal markets. Alongside these anchor replacements, Daniel invested in the kind of advanced leasing and analytics tools that top-tier mall operators increasingly use to make data-driven decisions instead of gut instinct. Firms including McKinsey have documented that shopping centers using advanced sales and traffic analytics to guide tenant selection, store placement, and rent negotiation have been able to increase their overall leasing revenue by double-digit percentages, in some cases pushing total revenue up by roughly 20%, simply by understanding which combinations of stores actually drive cross-shopping and which tenants quietly cannibalize each other's sales instead of complementing them. Daniel used this same logic to rearrange his tenant map, deliberately clustering complementary categories together and separating competing ones, something the property's previous ownership had never bothered to analyze. He also pursued a modest retail media strategy, selling advertising space on the mall's digital directory screens and entrance displays to both mall tenants and outside brands who wanted access to the specific demographic that walked through his doors every week, turning what used to be a pure cost center, the screens and signage budget, into a small but growing profit center instead. None of this happened instantly, and it wasn't cheap. Redeveloping a single large anchor box, including the structural work needed to convert retail floor plates into medical or fitness use, commonly runs into the tens of millions of dollars depending on scope. And financing that kind of capital improvement while the property is still recovering occupancy is one of the most stressful parts of commercial real estate ownership. Lenders get nervous when net operating income dips. Loan covenants can be triggered. But Daniel had underwritten the deal from day one, assuming this exact scenario might happen, because seasoned investors in this asset class know that betting on a single aging anchor tenant surviving for decades is not a strategy, it's a hope. Roughly 2 years after the anchor closure, occupancy at Daniel's Mall had climbed back above 90%, driven not by a single big replacement tenant, but by the diversified mix he had deliberately built. Sales per square foot across the property rose as the new medical and fitness tenants pulled in visitors who then spent money elsewhere on site. Exactly the halo effect that top-tier mall analysts have documented at the highest performing properties in the country. This distinction between top-tier and lower-tier malls has become one of the defining storylines in commercial real estate over the last several years. Malls with strong locations and the right mix of experiences have kept growing, even while headlines continue to declare the death of the American mall. Industry data breaks the entire national mall inventory into tiers based on sales per square foot, and the split is stark. The strongest properties, generating more than $500 per square foot in annual sales, run vacancy rates below 6%. The weakest properties, generating less than $300 per square foot, run vacancy rates more than double that, north of 13%. The lesson embedded in that gap is simple. This is not an industry that is uniformly dying. It is an industry that is sorting itself into winners and losers faster than almost any other category of commercial real estate. And the winners are the properties that reinvented their tenant mix and their revenue model early instead of waiting for the market to force their hand. This bifurcation shows up clearly in how investors are now pricing these properties. For years, enclosed malls traded at unusually high capitalization rates compared to other retail real estate, often 400 basis points or more above grocery-anchored shopping centers, reflecting how nervous institutional capital had become about the entire category. But by early this year, analysts at multiple commercial real estate research firms had started describing well-positioned enclosed malls as genuinely mispriced relative to their actual operating performance, noting that fewer than 10 new enclosed malls have been built in the country this century, while total inventory has shrunk from roughly 1,400 properties, down closer to 1,000, a classic supply and demand setup that tends to support values over time once operating fundamentals stabilize. Shopping centers more broadly entered this year on track for record pricing, with billions of dollars in fresh capital flowing into the sector and average pricing per square foot hitting an all-time high, driven largely by landlords finally getting the chance to reset years' worth of below-market leases signed before the pandemic. When Daniel eventually refinanced his property using its new, more stable net operating income, the appraisal came back at nearly double what he had originally paid for the mall 3 years earlier, even though total square footage hadn't changed and even though roughly 15% of that square footage was no longer traditional retail at all. That number is the entire lesson condensed into a single figure. He didn't make that money by selling more merchandise. He made it by owning the platform on top of which merchandise, healthcare, fitness, food, and entertainment all happen to be sold. And by understanding that the value of a commercial property is ultimately a reflection of the income it reliably produces, not the category of business printed on the sign out front. It helps to understand where this whole model came from in the first place, because the economics didn't appear by accident. The enclosed shopping mall as a format exploded across the United States in the post-war decades, riding alongside the interstate highway system and the boom of car-dependent suburbs, with well over 1,000 malls constructed just in the 1950s alone. Developers back then figured out early that the real money wasn't in operating stores themselves. It was in owning the real estate and collecting rent from the retailers who wanted to be near each other, because grouping competing and complementary businesses together under one roof created more combined foot traffic than any single store could generate on its own. That basic insight, that a landlord profits by curating an environment other businesses are willing to pay a premium to be part of, is still the exact same insight driving Daniel's spreadsheet today. It has just been updated for an era where the environment increasingly needs to include things you cannot buy on a phone. This is also why so much of the industry's attention over the last few years has shifted toward what analysts now call the halo effect. Brands that operate both a physical storefront and an online store consistently report that shoppers who can see, touch, and try on a product in person convert at higher rates and return items less often than customers who only shop through a website. And physical stores have become a meaningfully cheaper way to acquire new customers compared to the rising cost of online advertising. High-end mall operators have leaned hard into this dynamic, reporting strong demand from both traditional retailers and newer digitally native brands that started online but now want physical flagship locations, specifically inside successful malls, because the mall's existing foot traffic effectively works as a discount customer acquisition channel. It is worth being honest about the brutal side of this industry too, because Daniel's turnaround story is the exception, not the rule, and plenty of properties that tried the same playbook simply ran out of time or capital before it worked. Sears and J.C.Penney, once considered can't-miss anchor tenants capable of anchoring almost any regional mall in the country, both slid into bankruptcy over the past several years, and the collapse of those chains alone left hundreds of enormous anchor boxes sitting empty across the country almost simultaneously, flooding the market with vacant big-box space far faster than developers could find new uses for it. More recently, chains including a major department store operator, a national pharmacy chain, and several specialty apparel retailers have announced rolling waves of store closures stretching across multiple years, with total planned retail closures nationwide running into the thousands during this year alone. Every one of those closures represents a mall owner somewhere having the exact same conversation Daniel had with himself after his anchor left, weighing whether to fight for a traditional retail replacement or pivot the space towards something entirely different. The properties that pivot early tend to fare much better than the ones that wait, because a vacant anchor box sitting empty for years doesn't just lose its own rent. It actively drags down the perceived value and foot traffic of every tenant around it, creating a downward spiral that gets more expensive to reverse the longer it's allowed to continue. There's also a demographic story quietly reshaping this entire industry that doesn't get nearly as much attention as store closure headlines. Younger shoppers, specifically those in their late teens and early 20s, are actually buying a larger share of their general merchandise in physical stores than older generations do, a reversal of the assumption that younger consumers would abandon brick and mortar retail entirely in favor of shopping exclusively online. Surveys of shopping behavior show that consumers in this age bracket made a clear majority of their general merchandise purchases in person rather than online, driven by a desire for instant gratification, the ability to try things on before buying, and a genuine appetite for in-person, social experiences that simply can't be replicated by browsing a feed alone. This generational shift is a major reason experiential retail concepts, meaning entertainment venues, interactive installations, immersive events, and food-heavy environments, have become such a central part of how successful mall owners are redesigning their properties. Because the goal has shifted from simply maximizing the number of stores per square foot to maximizing the number of reasons a person has to physically show up and stay for a few hours instead of a few minutes. Longer visits translate directly into higher spending, and mall operators track average visit duration as closely as they track occupancy rates for exactly this reason. All of this ties back to one more piece of the financial puzzle that separates a good mall investment from a bad one, and that's leverage, meaning how much of the purchase was financed with debt versus paid for with the owner's own capital. A mall generating strong net operating income can still be a poor investment if it was purchased with too much debt at unfavorable terms, because interest payments come out before any profit reaches the owner, and refinancing a heavily leveraged property during a downturn, exactly when net operating income is falling and lenders are getting nervous, can force an owner into selling at the worst possible moment. Daniel structured his original purchase with a conservative amount of debt, specifically because he assumed there would be a rough stretch somewhere in the first few years, and that discipline is precisely what gave him the breathing room to fund the anchor box redevelopment without being forced to sell during the low point right after his department store tenant left. That single decision, made on day one before he had signed a single new lease, mattered more to his eventual outcome than almost anything else in the entire turnaround. Zoom out from Daniel's single property, and you can see the exact same forces playing out across the entire country right now. Retailers nationwide are still closing thousands of stores every year as chains like department stores and pharmacy operators shrink their physical footprints and shift more of their business online, and headline numbers on store closures continue to sound alarming in the news every few months. But at the same time, cities and developers are treating aging, half-empty malls as one of the most valuable pieces of undeveloped land left in built-out suburban America, because these properties already come with something almost impossible to recreate from scratch. A large contiguous parcel, existing utility infrastructure, established road access, and, crucially, decades of consumer habit already pointing people toward that exact intersection. Municipalities from Ohio to Virginia are now actively partnering with private developers to convert struggling mall sites into what planners call 15-minute neighborhoods, walkable mixed-use districts where housing, healthcare, retail, and open public space all sit within a short walk of each other, deliberately designed to recreate the sense of a town center that many American suburbs never actually had. None of this means every mall in the country is going to be saved. A meaningful share of the weakest properties, the ones with the worst locations, the oldest and least flexible building structures, and the thinnest capital behind them, will continue to close, get demolished, or sit vacant for years before anyone finds a viable use for the site. But the properties that survive and thrive are increasingly the ones whose owners understood something that has nothing to do with fashion trends or e-commerce statistics, and everything to do with the basic mechanics of commercial real estate. The mall itself was never really the product. The product was always the traffic, the location, the lease structure, and the flexibility to keep reinventing what happens inside four walls in a parking lot as consumer behavior keeps shifting underneath it. Daniel still walks his property most mornings before the doors open, past the same dark corridors, the same silent fountains, the same lone security guard doing rounds. But now, when those doors open a few hours later, some of the people walking in are there to shop, some are there for a doctor's appointment, some are there for a spin class, and some are just there to eat lunch with a coworker. Every single one of them, whether they realize it or not, is contributing to a rent roll, a percentage rent calculation, a CAM reimbursement, an advertising impression, or a parking transaction that flows back to the same person who never sold them a single thing. That, in the end, is the real business model hiding behind every shopping mall in the country. It was never about what's on the shelves. It has always been about who owns the floor underneath them